Okay, now I'm on chapter 8. So first for chapter 8, I'm going to work problem number 4. Problem number 4 is a problem where I'm doing the problem and then you're going to work basically the same problem with different numbers. Okay, so let's take a look here. So they tell us that on April 8th, 2018, Holly purchased a residential apartment building. The cost basis assigned to the building is $800,000. Holly also owns another residential apartment building that she purchased on November 15th, 2018, with a cost basis of $500,000. So we want to calculate her total depreciation for 2018, which is the year in which she purchased both of these buildings. And then we also want to calculate her depreciation for the second year in 2019. So we're going to need these depreciation tables that I have opened up that I'm going to show you in just a minute. So first, for this first building, they tell us right here that the cost is $800,000. So let's first calculate 2018. So in 2018, we have a building that was purchased with a cost basis of $800,000. And we're going to need to multiply that by some percentage. And that some percentage is going to show up on this table. So we need to know when she purchased it. It was in April. This is residential real property because it is an apartment building. And she purchased it in April. And so notice here on the table that it says the applicable annual percentage is, use the column for the month in the first year the property is placed in service. This is the first year the property was placed in service in 2018 in April, so 2.576%. So we're going to multiply this by 2.5, what was the number? 76%. And then we also have a building, let's go back to this, that was purchased for $500,000. And that building was purchased in November. November is month 11, so we're going to use 0.455%. And that calculation is going to give us 2018. Let's set up 2019. Okay, so for 2019, she owns both properties for the entire year. So we don't need to go to month 4 or month 8 or month 11 or whatever. She owned the building for the entire year because she bought it last year in 2018. So for both buildings, we're going to use 3.636%. 3.636%. Okay, I think I got screwed up. I think I was talking and I forgot to hit resume. If I didn't and I just got confused and confused myself, then I'm sorry. I'm repeating myself. But I don't think that it was recording when I finished up. So perform these calculations. This is the answer for the first year, 2018. And then we have the calculations, and then this is the answer for 2019. Okay, now we're going to look at problem number 8. Okay, problem number 8. This one is just a little bit tricky, so that's why we're doing this one together. Okay, so we have William purchases the following capital assets for use in his catering business. He bought a new automobile and baking equipment. And they tell us that William decides to use the election to expense on the baking equipment, but not on the automobile. They tell us that the automobile is 5-year property, which is nice, so we don't have to look that up. He also uses the maker's accelerated method to calculate depreciation, but elects out of bonus depreciation. So, first, we need to start with, so we're expensing, let me write that different, election. He's expensing the $6,500 in the baking equipment. Okay, and then now we need to decide what's going to go on with this automobile. So we need to look at two different files here that are part of this problem. So first we need to look at the depreciation table, which I have right here. Nope, right here. And remember, they told us this was 5-year property, so we're in this column. And this is the accelerated depreciation table, so we're on the right one. They gave us the right one in the problem. This is recovery year 1, so that is 20%. Let's go back here. So we have 51,500 times 20%. And what is that number? Let me just get my calculator. That's 10,300, but we can't just assume that that's our answer, because they also give us the annual automobile depreciation limitations. And then one thing that we want to remember when we look at this file that we're about to look at is that he elects out of bonus depreciation. So he's not taking the bonus depreciation. So let's look here. This is year 1. It's for an automobile. Automobile depreciation can be all the way up to $18,000 if he was including bonus depreciation, which he's not. So we can't use the full $10,300 because we have to take $8,000 out of this $18,000. So what this is telling us is that he can only depreciate $10,000 because $8,000 of this $18,000 limit is bonus depreciation, which he decided that he doesn't want to take. So we can't do 10,300. We can do the 6,500 plus only 10,000. And then that would be the answer, 16,500. Okay, now let's look at problem number 14. Number 14 deals with intangibles. So if you took financial accounting, which most of you have before taking this class, you remember calculating depreciation and then calculating amortization for financial reporting purposes. Here we are in this chapter calculating the numbers for tax purposes. And then you can see there's differences, right? There's differences between what you're going to put on your tax return and what's going to show up on your financial statements. Well, what the heck is going to happen to all that stuff? You're going to see that when you get into intermediate accounting, if you go on to get your bachelor's in accounting. It's going to create what's called a temporary difference. Differences between taxes and what's on our financial statements create what's called temporary differences. And those temporary differences end up showing up on our balance sheet as either assets or liabilities. So that's something that you can look forward to when you get to intermediate accounting. It usually shows up in intermediate accounting 2. And that's where it was the last time I taught intermediate 2. I would imagine that it's would be there in pretty much the way any school is doing it because it's more of an advanced topic. But just in case you're wondering what goes on with that stuff, you're going to see what goes on with that stuff. Okay, so here Derek has a small business and he bought some fixed assets, goodwill, and also paid some money for a covenant not to compete. How much of the $325,000 is intangible assets? So remember, the word intangible means you can't see it or feel it or touch it. Fixed assets, that's like a piece of machinery, an automobile, the desk and the table that I'm using right now. I can touch them, I can see them, I can feel them. Those are not intangible. But goodwill is an intangible asset. I don't know how much this book went into goodwill because I didn't specifically look for that, but basically goodwill is this extra amount that gets recorded on a company's financial statements when they're paying over basically the book value of a company. And it's much more complex than that, but you're not actually getting like a piece of machinery or a piece of equipment or a desk or a chair. So goodwill is an intangible asset. And a covenant not to compete, that's a contract. That's an agreement. That's not a piece of machinery. So the goodwill and the covenant not to compete are both intangible assets. So part A is $105,000. And then part B, what amount can Derek deduct on his 2018 tax return as section 197 intangible? So we want to take the 105,000 and divide that by how many years? Intangibles are amortized for tax purposes over 15 years. So that gives us 105 divided by 15. So that would be $7,000 for the whole year. But he didn't own these for the whole year. He only owned them for half of the year. July, August, September, October, November, December. 6 out of 12 months. So we're going to divide that by 2. And we're going to get, oops, nope, 3,500. So 3,500 is the answer to this one. Okay, one more problem. We're going to do problem number 16. And I know I've mentioned this before, but my favorite problems are when we get to fill out these forms. It's just so fun. And it's kind of easy the way we're doing it too, because they give us all the boxes that we're supposed to use, and they don't give us boxes when we're not supposed to put things in. So it makes it way more easier than if we were just getting a blank form off the IRS webpage and trying to fill it out. Okay, so what I would recommend doing so that you can see the information, this information that's right here, maybe have it in front of you somehow, like copy and paste it and put it somewhere, because I'm going to be referring to that, but I can't show this while I'm down here working. So I'm using all this information right here to fill out the form. So we've got the office equipment and the land, and they give us all the information that we need. We're going to fill it out here. So we've got office equipment. The office equipment was acquired, they told us, on July 1st, 2016. It was sold on March 15th, 2008. The sales price was $13,000. The depreciation, $3,000. So I'm just using the information they gave us in the problem. The cost basis, $19,000. So what is my gain or loss? So cost minus depreciation, $16,000, right? $16,000, and then we sold it for $13,000. So we sold it for less than its book value, which was $16,000. You know what? I should do this here. So we should all remember how to calculate book value because we did it in financial accounting, but purchase price. So if we take the sales price, no, sorry, not sales price. Cost minus depreciation equals the book value. So cost is 19 minus depreciation gives us a book value of 16. And they tell us that we sold it for $13,000. So minus $13,000 that we sold it for gives us a $3,000 loss, right? And it would be a loss because we sold it for $3,000 less than its current book value. Losses they want in parentheses. Oops, okay, you have to enter it in as a negative, and then it's going to make it be in a parentheses. Cool. The land we bought on February 1st. We sold it on April 19th. It was sold for $124,000. Land is never depreciated. We bought it for $138,000. So we have another loss. We don't have to worry about book value or depreciation because land is not depreciable. So we have a loss of $14,000. Combine lines 2 through 6. All we have is stuff on line 2. $17,000. Loss, if any, from line 7, which is what we have up there as a loss. Combine lines 10 through 16. Well, all we have is what's on line 11, so it makes it super easy, right? And 18B, just carrying the same number down. So that was actually pretty simple. Cool. Is that the last one I was doing? Yes, that's the last one I was doing. So we are done with Chapter 8. Oh my gosh, the semester's almost over.